Hey everyone, welcome back to Monday Money in a Minute. It's Alan here. So, one of the most dangerous sentences I hear in lending is, we've got pre approval, so we're good to go, right? I understand why people think that, but the bank has looked at the application, they've given it a number, you've started inspecting properties, feels like the hard part's finished, right? But pre approval is not the finishing line, it's permission to keep moving forward. And confusing as the two can create a very expensive problem. Let's open the black box. Here's your Monday Money Minute. Pre-approval usually means the lender has reviewed the information available at the time and believes that your application may fit within its rules. But that's not an unconditional promise to lend. Before the final approval, the lender may still need to check the property, confirm the value, verify your income and documents, make sure that the financial position hasn't changed, and confirm that the application still meets the policy when you're ready to proceed. A new debt, change of employment, an unsuitable property, an expired approval, or information that doesn't match the original application can all affect the outcome. So treat a pre-approval like it's an important checkpoint, not a guarantee. So that's your Monday Money Minute. Now, let's open up the black box. I remember a couple who had received the pre-approval and naturally thought everything was settled. They found the property they loved, they were emotionally committed, they were already picturing themselves living there. Then the property itself created a problem. Nothing that anyone had necessarily gone wrong with their income, nothing that had suddenly changed in their intentions. The issue was that the pre-approval had assessed the borrowers. It had not fully approved the particular property and the final transaction. And that distinction matters. The home loan has two major sides. First is the borrower. Second is the security. The lender needs to be more comfortable with both. The borrower can look perfectly acceptable, but the lender may still have concerns around the property. It could be the valuation, the location, the size. There's sometimes restrictions on size of property. The construction type, the condition of the property, the title, what you're going to use it for, or something else in the contract or the transaction. So that's why a pre-approval cannot fully approve a property that you haven't chosen yet. So what has usually been assessed? Depending on the lender and the type of pre-approval, they may have considered your income, your living expenses, your existing debts, your credit history, your deposit or available funds, the proposed loan amount, and the general type of property that you want to buy. But some pre-approvals are more thoroughly assessed than others. Some involve a full credit assessor reviewing the whole application and the documents. Others may largely be just computer generated. That doesn't make them useless, but it does mean you should understand exactly what you received. So, what can still change? Well, a lot can happen between a pre-approval and the final approval. You might change jobs, reduce your working hours, take out a car loan, increase a credit card limit, take out a buy now, pay later or afterpay account. You might use part of your deposit. I've seen that happen. Miss a repayment on something, or apply for other credit somewhere else. The lender may also update their interest rates, assessment rates, credit policy, and usually a small change does not automatically destroy the application. But the point is this: the original lender's decision was based on a particular set of facts. If those facts change, the answer may also change. But the property still matters. This is the part that many buyers underestimate. The lender may not simply approve your maximum purchasing price, it's assessing the specific property that you eventually choose. If you pay $1 million for a property, but the lender only values it at $900,000, the lender normally works from the valuation, not simply the contract price. So that can affect your loan to value ratio, LVR, your deposit, how much deposit do you need to put in, whether now it needs lender's mortgage insurance, and sometimes whether the transaction can proceed at all. So the property has to fit the lender's security rules. Some lenders are cautious about really small apartments, usually less than 40 square metres, serviced apartments, unusual construction, company title properties, properties in a particular location, large rural properties, more than 50 hectares, or properties with substantial commercial use, so up, down, business down, property above. Different lenders may take different views, which brings us back to the purpose of the pre-approval. It helps establish whether the borrower appears to proceed within that range. It does not remove every condition from the final decision. So today's rule, pre-approval is an important checkpoint, but it's not the final approval. It tells you that you may be on the right road. It does not give a guarantee that the property, every contract, and every future circumstances will still fit. It does not mean that you should be frightened to make an offer. It means you should understand what remains outstanding before you commit yourself. So this week's action. If you already have a pre-approval, ask your broker or lender for one simple question. What could stop this application from becoming a final approval? Then ask, has a credit assessor reviewed my documents, or is it approval mainly system generated? Those two questions will tell you far more than simply seeing the words pre-approved. And before you sign a contract, make sure you understand the finance clause and the risks of going unconditional. So next week, next Monday, we'll look at another misunderstanding that I hear all the time. My house is worth $1 million and I only owe very little. Why can't I borrow another $500,000? Which brings us to rule number 5. Equity is not the same as borrowing power. So I'm Alan Taylor. Thanks for joining me on Monday Money a Minute, and I'll see you next week.